Yes, if you take over a company, you buy a full company, and you pay more, so if the market price that you pay or market value is higher than the assets on their balance sheet.
Okay.
Then you're suddenly allowed to put that price that you paid on top of that on your balance sheet, and you're allowed to depreciate it over time.
Yeah.
That's what the goodwill is. But again, the point is that why did you pay more for the company than the balance sheet value? So they must have something valuable on their balance sheet, or valuable, right? That's why you were willing to pay the price for it, but they're not allowed to put that in your balance sheet numbers. After the purchase, you were allowed to do that. That's the goodwill.
Yeah, yeah.
But before the purchase, the initial company was not allowed to do that.
For example, number of users, if we like keep in mind the Twitter, so like he doesn't buy it because of the asset price. Let's say.
Yeah. So Twitter probably doesn't have a lot of assets, maybe a couple of computers, right? That's it.
Yeah.
But the market value is much, much higher than that. Right? That's a very good example of the company. So where does the value of the company come from? So users.
Users like.
What else?
I'm just trying to translate what's in my mind.
Any other idea that makes Twitter valuable?
The good name of the company?
Yeah, so brand name, right? Brand recognition, reputation.
But the conditions of the market, because they are not mentioned in the balance sheet, but still, if the market is stagnating, you could not expect, let's say, for the stocks to grow.
Future expectations from the market, very good. So if you would find a name in the accounting language for these factors that you mentioned, how would we call this? Opposed to the things that are on the balance sheet. The difference is, so you described it perfectly, so that what is on the balance sheet we call as tangible assets, right? The others are the intangibles, correct? And you're only allowed to put intangible assets on your balance sheet if you paid for it. That would be the goodwill, for example. Can you give me other examples for intangible assets behind users, reputation, kind of market expectations?
Patent rights.
Yes, exactly. So the patents and basically everything that comes out of research and development, right? So that's a very big portion. So the growth stocks are companies usually with a large number of intangible assets, right? Software, computer software, where you might have patents on them. That's all included in growth stocks. So value stocks are those who have lots of tangible assets. They might have some intangibles, but the tangible ones dominate their balance sheet. And the growth stocks have lots of intangible assets. And maybe that's the first view. Look at intangible assets. Brand names, reputation, patents, and so on. There's another perspective. So suppose a company has a market-to-book ratio of 2. That means the market value is twice as much as the book value. Would you buy the company? Is that a good sign? That's your basis for your information, basis of your decision, the basis of information that you have.
No.
Yes. Why
Because
would you
it's
not?
expensive. It's basically traded like
Yes.
more expensive than it is like the tangible assets are.
Exactly. So what analysts and what you even find in textbooks sometimes, which I wouldn't agree to this, just to be upfront with this, but they're labeled as expensive, and if you have your low market-to-book ratio, then you're labeled as cheap, right? So because you're paying less than the balance sheet value, and why I don't like this is because there's an implicit hypothesis behind it saying that the book value is the correct value, right? So if you buy it for less, then make a good deal. If you pay it more than the book value, it's a bad deal. But given our previous discussion about intangible assets, you already know that that is a very insensible argument. People also say instead of cheap and expensive, they say undervalued and overvalued. And I really hate this terminology because first of all, you always need to make a comparison. Overvalued means with respect to what, right? And claiming that the book value is a good valuation for the company is really sketchy. So, but besides that, if you compare something to like have a model in mind that produces a value, then well, you might be true. The company might be overvalued according to your model. But there's also a second chance, namely your model is wrong. So I really hate to personally try to avoid these things and try to be more agnostic. Say the model forecast will be this and the price is higher than that. That's a completely non-judgmental statement, right? Very neutral and correct. If you just say overvalued, then you're making the statement, a judgmental statement, saying the price should be lower, right? And I wouldn't have the guts to say that, because you always should account for the possibility that actually you are the person who's wrong, the others are right. Okay. But now coming back to our example, so the analysts typically say that, and if you study, do balance sheet analysis, that's what you even hear in classes, that the stock is expensive, it has a high market to book ratio. But think about it in terms of kind of value generation. So if you put €1 in the balance sheet of the company, right, that has a market to book ratio of 2, how much value do you get out of this? Twice of it, right? So suddenly it seems like a good idea, right? You have to put €1 in, but they generate €2 of value from it. Right? So this comes back to your point on the market expectations and then of the market environment. So that's actually a company that has growth opportunities. They're able to create value, right? That's why they have a higher market value than their book value. They were successful. You put money in them and they grow it. Right? That's actually a good sign. Conversely, if you have a company with a low market to book ratio, 0.5, so if you put €1 in, you only get 50 cents of value. So these are burning value, they're destroying value. These are bad companies actually, or at least. But think about it in terms of kind of value generation. So if you put €1 in the balance sheet of the company, right, that has a market to book ratio of 2, how much value do you get out of this? Twice of it, right? So suddenly it seems like a good idea, right? You have to put €1 in, but they generate €2 of value from it. Right? So this comes back to your point on the market expectations and then of the market environment. So that's actually a company that has growth opportunities. They're able to create value, right? That's why they have a higher market value than their book value. They were successful. You put money in them and they grow it. Right? That's actually a good sign. Conversely, if you have a company with a low market to book ratio, 0.5, so if you put €1 in, you only get 50 cents of value. So these are burning value, they're destroying value. These are bad companies actually, or at least companies who had a bad trajectory in the past usually. Right? So the losers tend to have low books to market values, the winners tend to have high market to book values. Like Tesla, for example, has a market to book value of 38 at the moment, I think when I looked it up the last time. So it's a ridiculously high number. But they have growth opportunities, right? They're expected to grow quite a lot, and they're a very valuable company. Right? So these two factors here play a role when you analyze that. Now the surprising thing is that the value stocks have higher returns than the growth stocks. If you again make a comparison to stocks with the same market beta, you will find that the value stocks outperform the growth stocks. And that is, again, something that's very, very difficult to explain if you want to make a risk argument. So why are these things riskier than these? Right? So maybe you say that these are kind of companies with outdated business models. They're not expected to grow. That's why they're risky. And the growth stocks have these growth opportunities, and that's why they're less risky in the long run. But again, this is something that kind of research hasn't really settled on what a good explanation is. Fromm and French don't provide any explanation at all. They just kind of say that that's the observation in the data. They're empiricists. They don't formulate theories. Good. So these are probably the most two important puzzles, and there is a way of incorporating kind of these things into your computations. And I want to just show two of the ways of how you could modify. Maybe let's talk about the one at the bottom here, the so-called multi-factor models. So what you can do is basically you can explicitly incorporate the factors like the size effect and the value effect and the momentum effect in your return estimation. Right? So if you run a regression and you want to follow the Capital pricing model, you have one beta and one explanatory variable, which is the market return. Right? However, you can just add more variables. Right? More variables should have a higher explanatory power. And that's the general idea behind the model that Fromm and French created. So they included two more factors to explain it. Right? More factors are always improving. And this is probably the most commonly used model to explain returns, the three-factor model. I think they have proposed a new one just recently with two more factors. One is, I think, called, one is about investments, firm investments, and the other is It's called robustness. Yeah, so you can explicitly do that, run a regression with multiple factors, and throw in as many explanatory variables that you like. Now there is a discussion around like which of the 400 available factors do you throw in, and which ones are kind of not required. And the problem is that they're all correlated with each other, right? So if you look at firm size, for example, that might be highly correlated with the revenue of the company. The larger the firm, the more revenues you have, right? So if you put in both variables, they might look very similar, right? So is that really necessary? In statistics, you run a risk of over-explaining if you add too many of those 400 variables. So that's actually a very kind of recent and current research topic, is like which of those 400 do you pick, right? Which ones are the best, or kind of how do you reduce the complexity of the data? And it seems that people settle around 7 to 8 factors on average, but again, it's kind of not really, there's no kind of perfect solution around it. Right, so the Fama-French model is probably the most used one. You just add more factors to your regression. But be careful, this is an empirical model. The capital asset pricing model that we discussed before was a theory with equilibrium assumptions. At Fama-French, they don't make this equilibrium assumption. They just say, well, in the data I observe this, so this seems to be an important variable, so I should include it. Right? That's their statement. There's no proof, nothing, no derivation, no fancy pictures like in portfolio theory. They just stated this is the way how it works. And empirically, it's good, right? It works well, right? But it's not well funded and doesn't have a basis in theory. So multi-factor models is one thing. And you always use these multi-factor models when you want to have very good forecasting power. So in asset management, if you're investing money, these factors are pretty important. So factor investing strategies are quite important. Now, if you would just want to estimate the cost of capital of the company, like what's my discount rate to use to compute the value of my company, or to evaluate investment decisions and capital budgeting, you wouldn't do this. This is not what corporations do. This is what investors do. Corporations sometimes use this approach up here. This follows a researcher called Vazicek. He's a statistician. But the company that made it popular was actually Bloomberg. So Bloomberg provides you two numbers for the beta, the so-called raw beta and the modified beta. The raw beta is the actual number that you estimate from the data. But then they manipulate that. So what they do is they basically move the beta here towards 1.